People are panicking in the markets as they do, but like the title and thumbnail of this video, I want to give people a bit of comic relief and really, especially for the newcomers to this market, to tell everyone that don't be fooled. We are still clearly in a bull market. We are way far off from the level of volatility you can see in this market. And aside from price analysis, which we'll do in a bit, we will also look at the FOMC news from yesterday, what the Fed actually announced when it comes to interest rate hikes, the hawkish stance of Powell, why this doesn't actually matter, and what this actually means. And also the other side of the FOMC announcement is with their Federal Reserve balance sheet, their status on that, whether they're doing QT or QE. So we'll dive into that as well. And long story short, it really doesn't matter what rate cuts will have to be. The inflation part just means that the Federal Reserve balance sheet QE stance has to be delayed. So the money printer has to be delayed before it comes back on. But like people do, as always, they buy high and sell low. So we have to make updates to keep people in check and to make sure that people don't over leverage and wreck themselves. So that's on the agenda for today, and let's get started. So if you're new to the channel, welcome. My name is Dennis. I'm a crypto angel investor for the past 6 years, and I have invested in over 100 crypto startups. On this channel, I share views on market trends and investing strategy to build wealth in crypto. So there's a couple things to get us started first. Let's just quickly show you guys the charts of today. So I really like this meme that I put in the thumbnail. Basically, it's this cat screaming, why is it going down? You really have to zoom out here. Purely looking at T8 perspective, we are still way on track like in Q4 2024, Q4 2020. And if you zoom out, this blip right here, this is the panic people are feeling. And what's going on? How could you possibly call this a crash even? It's really not even a crash level yet. From the very top, we are barely 10% down. If you cannot swallow a 10% move towards the downside on Bitcoin after this kind of a move over the past 40 days, where Bitcoin had a 54% pump, and then, what is this? From the very top to right now, 9.7% dump, right? 10% dump. Like, this is totally healthy. So you can't really say that this chart is crazy, right? You really just have to zoom out. And that's not even using any indicators, any whatever. Specifically though, the bull market indicators, most importantly, two of the exponential moving averages, the 21 weekly EMA, that's this blue average line, that currently sits at 79,000, just at 80,000. So Bitcoin on the weekly time frame, it could drop all the way to 80,000. And that still would tell us that we are still in a bull market. And then on a daily time frame, we need to look at the 200-day EMA, which currently sits at 73,000. So on the daily, we could wick all the way down to 73,000, and still you cannot panic. These are the types of moves you need to be ready for in a bull market. Now, obviously, I'm not saying this needs to happen now. This is the bottom line. And you can't just say, oh, because Bitcoin has ran up a lot, these targets and these support levels, all of a sudden they don't matter anymore. You can, chase higher and higher. That's not how things work. So I'm not saying I'm expecting anything close to 80K. I think Bitcoin is in a very strong spot, but just something to keep in mind. We are still very much in a bull market. And also you got to consider the higher highs and higher lows. And here is the daily time frame. So on maybe a intraday, let's say 4 to 12 hour time frame, we have the last higher low right here at 94. So currently this drop came down to 95.6. So even on a 4-hour time frame, this is still uptrend, right? Higher low, higher low, higher low, higher low, higher high, higher high, higher high. So if we just bounce from here, this would be very good. But even if it doesn't, looking at the daily higher lows, there are still so many more levels. And on top of all of that, if we drop all the way down and retest the previous breakout at 73, like, and what, we drop to 74 and you're going to all of a sudden say, oh, I gotta sell? Like, come on. That's just means you are over leveraged and you haven't been prepared for the volatility. Okay, so that's basically all the certainty we're going to get in the bull market, which is as long as Bitcoin respects 21-week EMA at 79,000 and 200-day EMA, which currently at 73. 200-day EMA currently at 73. This is going to tick higher as price continues to trade up. So the 21-week EMA at 79. This is a more practical level right now. If you cannot swallow even the possibility of this happening, then this market is going to rinse you. You will not be able to hold till the end of the bull market. Now, one of the most important things that will help you to manage these types of risk is one tip, which is to not take on leverage. I have made this point quite a few times in past videos whenever we talked about trading. In this video, last month on November 8th, when Bitcoin was still relatively low at 76,000, I was already warning people, right? Okay, we went to 76,000, make new all-time high, and people all of a sudden think prices cannot drop. And even a 10% drop is not possible anymore. So I just gave people examples, right? How much can altcoins drop from here, hypothetically speaking, if Bitcoin makes a 10% drop. Now, at that time, that was from 77,000 to maybe 70,000. If that could have happened, we then compared altcoin volatility compared to Bitcoin volatility, and we saw that most altcoin sectors, even if they're strong, they have about 2 to 2.5x higher volatility than Bitcoin, which means if Bitcoin drops 10%, most of your established altcoins will drop 25%-ish. And that's what we saw happen, right? Just this past 2 days, Bitcoin from these two daily candles down 9.6%. And then you can basically look at most of your alts on CoinMarketCap. They're down somewhere between 20 to 30% range. And people are saying, wow, I cannot believe these altcoins are dead. No, that's just simple volatility. If your alts move up 2 to 3x faster than Bitcoin, then it's going to drop 2 to 3 times as more violent as Bitcoin does. So then, does that mean you cannot play alts? No, but it just means that you have to take those into consideration. And that means anywhere above a 4x leverage, you have a high probability of getting liquidated. If Bitcoin just drops 10%, then your alts drop 25, you get liquidated on a 4x leverage. So that's why using leverage is very, very risky in these types of markets. So whenever we talk about dip buying, etc., assume that spot buying with no leverage is going to be much better, because whoever doesn't have any leverage right now, it's fine, just keep holding. Most people at current point, they know that the bull run has not ended, but they see their leverage position going down and they have no choice but to sell. So that is a scenario you don't want to be in, so avoid using leverage. Okay, now that's all I'm just say on the charts. I don't think these charts really matter too much at the moment. You really have to zoom out and then you see the whole picture here. So the more practical stuff we can dissect is from yesterday's FOMC. So during yesterday's FOMC, quite a few pieces of information came out, and I made a quick TLDR summary yesterday on Twitter. So basically 3 main points here. I'm going to start with this most simple one, which is we got a 25 basis point rate cut, which was as expected. This basically meant nothing. And then the second point here that people really panicked on was that Jerome Powell, the chair of the Federal Reserve, came out and said that they wanted to signal a slower rate cut cycle in 2025. Specifically, during the January FOMC meeting, they are likely to pause rate cuts and not make a cut at that meeting, which is on January 29th. So a lot of people that don't understand this stuff, they just blindly think, oh, rate cuts, the more we cut rates, the faster prices run up, and we need aggressive cuts, more and more aggressive every time. This is a myth. This is completely false, okay? And we have dove into this concept before, right when the Fed started to cut rates. And you can see this on our live stream from September right here. So I properly named this stream a bit, and I changed the thumbnail as well, but the content is way more relevant to right now. So why rate cuts and recession do not matter for Bitcoin. And the TLDR here is that when you have a rate cut cycle beginning, like here, what history tells us is that when the rate cuts are very aggressive, that has always led to a recession. And a recession is the truly bad thing for a risk-on asset like Bitcoin, or even just the stock market overall. Because just think about it, like, why would the Fed have to aggressively cut rates? And when have they done that? This usually signals a huge shift, a huge credit event, a huge crisis, global pandemic, etc. And right now we don't have that. So the only reason why the Fed will cut rates more aggressively than people expect is actually a bearish signal that tells us something is wrong. So that's the first thing, which is you don't want to see aggressive rate cuts. So whenever you have people expecting 25 basis point, you want to see 25 basis point. You don't want to see 50. You don't want to see a double cut, a surprise heavier cut. That is actually way worse than people expect. So this is the first myth. You don't want fast, aggressive cuts. You want slows and steady. And the second is, look at this chart here. This is all of the previous recessions we've had since 1955, as marked out in shaded gray here. And then this blue chart here, this is the federal funds rate. This is the effective interest rate based on what the Fed chooses to target. And this is the number that the Fed tries to control with their rate cuts. So whenever we say a rate cut, that means this blue line starts to trend down. And whenever we say a rate hike, means the blue line trends up. So you see that I have circled out here. Every time that we have had a recession, as in this shaded areas, that was when the market crashed, right? All asset prices crashed. We completely want to avoid that. And look at what triggered those. Well, it was when we had these aggressive rate cuts, right? So when rates dropped very aggressively, each time, a few months after that, we had a recession. So this shows you real data over the past nearly 70 years that you don't want an aggressive rate cut cycle. You want a slow cycle. And one of the most important things we need to look out for from FOMCs over the next year is for a gradual rate cut cycle. So you see, once rate cuts begin, they need to come down. This is how the Fed works. The only way we can avoid a recession once a rate cut cycle begins is if the Fed can cut rates slowly. So we avoid one of these red circles, and instead something like, if I can show you just this one here. So this is the chart, the same chart. So instead of triggering one of these recessions with the shaded areas, what we need to see is for something like here in 1966, where you have a cut and then you pause and then maybe start to trend up again. Or back here, you cut, but then you pause, you raise a bit, and then you cut a bit, you raise a bit. This is something that's much more healthy than an aggressive rate cut cycle, or something like 1975 when you cut, but then you kind of start to go sideways, or back here you cut and then you raise a bit, you cut, you pause, you cut, you pause. Back here, 1992, cut, going into pause, right? So, and then from 95 until about 1999, 2000, this was a really good period for the market. Even though it was in a cut cycle, what happened was the cut was very slow. And at some point, the Fed decided, okay, we're going to pause the rate right here at 5.2 to 5.3%. And that lasted 2 years. And those years were good years. So this is the kind of thing you want to see, a slow rate cut cycle where you have sometimes a cut, sometimes a pause, sometimes a cut, sometimes a pause, is what you need for a bull market. What we don't want to see is, okay, Jerome Powell says, we want to cut 25, and then the next meeting he comes out and says, oh, actually, economy's broken, we need to cut 50. And then the next time he comes out and says, oh, actually, it still didn't work, we need to cut 75. That causes real panic, and that actually crashes the market. In the contrary, when he came out yesterday and said that we cut 25 basis point right now, but the next meeting we're going to pause. And then if you actually followed his language, why was he able to pause? It was because the economy is doing okay. It was because unemployment numbers are actually falling. So take a look at this chart here. This is the National Bureau of Economic Research. These are the people who actually decide when we are in an officially declared recession or not. And the only number that they care about is the unemployment rate. So whenever unemployment rate rises very sharply, that has triggered a recession that's indicated by them, announced by them. And what we know from the Fed over this rate cut cycle is that they have set a hard limit for them to have unemployment rate peak at 4.2%. And look at from August, right here, this little number here, from August 2024 until right now, September numbers, unemployment rate actually came down from 4.2 to 4.1. And you can track this anytime on TradingView as well. If I have that here, I don't, but you can, unemployment on rate, this is the one. You can add that in. On rate from the BLS, and you see, why do I have this slow here? Hide that. So you see, unemployment actually had a dip, 4.29 to 4.09, 4.1. This is really good. So this is the number that tells the Fed, okay, like economy is doing actually better than expected, and that's the signal that a slow rate cut tells us, which is the economy is doing okay, and we can afford to cut slower, which means the recession is at least more delayed. Each time that they pause the rate cuts, that means recession is delayed by at least another meeting, which is usually 1 more month. This is good. Okay, so that's the first kind of takeaway here, which is even though Powell has shifted to a slower rate cut cycle in 2025, this is actually very good. It means unemployment rate is in control. Now, the downside of this is that, well, inflation is still high, as they have shown in the numbers. So inflation, this is the projection material from FOMC yesterday. And you see right here, core PCE inflation, this is the number. And right now, most of the attendees have put this number, I believe, this is the median at 2.8%. And if you just Google US current inflation rate, we're at 2.75%, pretty much the same level. What's not good is this. So you see from October until today, inflation number has grew from 2.4 to 2.6 to 2.75. So this is the thing that people are worried about. Now, logically think about this. what's the direct cost relationship between inflation that it makes an impact? Well, it's purchasing power of your dollars. It's everyday stuff like groceries, living expenses are going to run higher. However, naturally, when inflation is high, asset prices are good, right? Well, this is true. The only downside here is that when inflation is rising, the Fed cannot do money printing. They cannot do quantitative easing. At least they need inflation to be falling in order for them to use their other tool, which is the money printer. This is the thing that will need to be delayed, which is this second point here that I have laid out. So because inflation will still be high, which is technically good for risk-on assets, however, the Fed is still selling assets because when inflation is rising, they cannot say, even though inflation rose, we're going to still print more money. They're going to look like idiots. So they cannot do that. And that's why in the last FOMC yesterday, I'm going to show you right here, December 18th, in the statement that they have made right here, December 18th FOMC statement, they said down, where is it? Here, this sentence. The committee will continue reducing its holdings of treasury securities and agency debt and agency mortgage-backed securities. This sentence means that they will continue selling their assets, selling especially their holdings of treasuries. And this means they're reducing their balance sheet and they are not printing more money to buy assets because, they cannot do this when we have high inflation. So that's the only thing that people got that is a cause for worry from this FOMC meeting. Now, I just want to tell people that even though they need to delay this, it is still inevitable. At some point, they will have to change this language. So they have kept using the same language for the past 2 years, that they will continue to reduce their balance sheet. And then you can also track this progress from TradingView. So right here, this balance sheet asset, total assets, WALCL, this is the number that tracks the Fed's balance sheet. And you see this number has been going down since April 2022. So this is what QE and QT means. So when you have QE, that means this number is going up. This chart is going up. That means the Fed is printing money to buy assets, boosting the risk on assets. And then when this number is going down, this chart is going down, that means we have quantitative tightening, QT, which means the Fed is selling their assets. Now, currently, they are still selling their assets. However, two signs tells me that they will have to make this shift and will have to take this number back up sometime soon. Why is that? So the first is outlined in our video here. So here's when the money printing will trigger the crypto bull run. We made this live stream on October 28th. I have done the full analysis of the past 8 years of money printing and money shrinking cycles. TLDR here is that the Fed will make early announcements during one of the FOMC meetings before they make the shift to go from quantitative tightening to quantitative easing, and then vice versa, go from quantitative easing to quantitative tightening. And usually they make that announcement between 4 to 8 months ahead of their actual pivot. So the last time that they made this announcement is, I believe, right, where was it? If I can check right here. Current time, it was May 1st, I believe. Yeah, May 1st, 2024, right here. This implementation notice here. So back in May, they have already made an adjustment. This is the early warning signal that they give, which is that they saw that inflation was going lower. So they could, beginning in June, they started to slow the pace of decline of selling from the Federal Reserve's balance sheet from a maximum of 60 billion per month to maximum of 25 billion per month. So they have already made the slow of selling, which every time before when this happened, 4 to 8 months after, they made another statement telling people that they completely stopped selling and plan to start buying assets again. So this is the first sign. The second is, well, very simple. Just Google US debt. US debt o'clock. I'm going to show you right here. Yeah, this one, like I'm sure you've seen some version of this before. This makes the ultimate endgame like super clear. The US debt situation is on everyone's mind. TLDR here is that US has unprecedented levels of debt, and the US government is paying even just the largest expense in interest payments for the debt it has. And there are three. So when the US has debt, right, what loses trust? It's the trust in the US government and the trust in lending money to them. So how does the US government borrow money? It's by issuing treasury bonds. So the trust in treasury bonds declines as more and more people realize that the US has a large debt problem. So everyone knows this now. And who are the three types of people that buy up US treasuries? Well, you have foreign entities, you have other nations, which are increasingly growing worried about both US dollar and US treasuries. So there's a shrinkage there. You have, just everyday local investors. How many people are actually investing in bonds today, getting like fixed income? The less and less people are doing that. And way more people are even like preferring to just straight up invest in the stock market. Even if they have to manage the risk by themselves, they would rather keep some form in cash and some form in actually liquid cash instead of bonds, and then some other in risk-on assets. Way less people are going into fixed income today. And the last group of buyers of US debt is the US Federal Reserve. So this is directly tied to this right here, the Federal Reserve balance sheet pivot, which we have shown before with the May announcement. Remember when they said that they were reducing the holdings of Treasury securities, and in this last FOMC meeting just that we had yesterday, when they said that the committee, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. So the Federal Reserve is the last buyer of last line of defense for the U.S. government to buy up treasuries. And right now, they haven't engaged in this. They haven't turned the money printer back on in order to pick up the tab of the U.S. government. At some point, they will have to, because as the U.S. debt problem cannot be solved, the trust in U.S. bonds will only decrease. So the only way that the U.S. government can actually make it out of this is to tell the Federal Reserve to just print more money and buy up Treasury securities. And when they buy up Treasury securities, that's exactly this. The pivot of the Federal Reserve's balance sheet going from this formation of decrease, which is when they are selling their holding of Treasury bonds, to increase when they are buying Treasury bonds. So why is it inevitable that this will happen sometime, maybe like this, or maybe a little bit more down like this, or just like this, right? Whichever trajectory that it happens, it has to happen. Why is that? It's because of this. is because nobody else is going to buy up US debt. Very simple. So this is why, even though we're getting, all these things coming out and Jerome Powell saying, oh, like we are going to have slower rate cuts because, oh, look, like inflation is coming back a bit. Like they have to make this work. They have to make inflation come back down. So either, inflation just stays or inflation comes back down. But at some point soon, during one of the FOMC meetings, Jerome Powell has to come out and say that we think it's okay. Either, inflation is going back down again towards their final terminal target of 2%, or inflation maybe stays at 2.5, and then they say, oh, you know what, we're happy with 2.5. We're going to make this balance sheet pivot. We're going to turn the money printer back on and start to buy assets, specifically starting from treasury bonds. If they do not do that, at some point, the US government is only going to have this bigger and bigger problem, and it's basically inevitable. So this is why, even though, inflation is rising, whatever, right? You don't have to worry. The main worry here is we don't want a fast cut, because the fast cut, like we said earlier, triggers the other bad thing, which is the business cycle going into a recession and the unemployment rate rising. But this is actually okay, because unemployment rate right here is stable. So this is good. Unemployment rate here stable is clear. And also because of this, Jerome Powell can say that we can cut a bit slower. So this is actually nothing to worry about. The Federal Reserve's no balance sheet pivot, it simply means it's going to be delayed. So each time that they come out and say, oh, look, like inflation is still rising, it's still high, so we cannot turn the money printer back on yet. Obviously, he's not going to say that. He's going to repeat the same sentence like this. The committee is determined to, like this is what he says, the committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. He's going to keep saying this exact same language because this is how the Fed works. He cannot give random signals. This first part, supporting maximum employment, is what we need to watch. And actually, this is perfectly stable right now. Unemployment is not an issue. We don't have a recession. It's getting further and further delayed, which is very good for the bull market. The second part of this, returning inflation to its 2% objective. This is the part that delays us for the explosive bull run. If inflation right now is already at 2% back down, which is this chart, if this chart just goes back down to 2%, right away the Fed can make this pivot, turn the money printer back on, start buying assets. At some point, they either say that, oh, inflation is down to 2% already, or they say that we are no longer committed to the 2% objective. Instead, we're going to adjust our goal to maybe 2.5. Either of those cases need to happen in the future FOMCs. And when that happens, they will change this language to go from reducing holding of treasury securities and reducing the balance sheet to stop reducing and start increasing. And when that happens, the explosive bull run will start. When can they do this? Well, you just have to track the upcoming FOMCs. This is why the FOMC actually matters a ton. I'm going to go give you the calendar right here. The next FOMCs in the year 2025. Next one is January 29th, and then following that is March 19th. So January 29th is right after Trump comes into office, right after Inauguration Day on January 20th. There's a high chance, a lot of people are expecting that the current administration just needs to give Trump a lot of trouble before he comes into office in order to just delay everything. This is honestly makes a lot of sense. So maybe by January 29th, we can already see this happen. If not, then we see it in March 19th. But either way, it has to happen. Each time that Powell comes out and says that we don't have the Federal Reserve balance sheet pivot, just means you look out for the next one. It just means the explosive bull run is delayed, but it doesn't mean it's not going to come. It is inevitable for it to come. So that's it. That's the ultimate like full analysis of the FOMC. There is no risk. There is actually a much lower risk of recession as Powell is cutting rates slower. When he cuts slow and when he pauses, this actually means unemployment is okay and we have delayed recession, less and less risk of recession. And when he says we don't have balance sheet pivot and inflation is still a little bit high, that means the money printer needs to be delayed. And that's all that means, because the money printer inevitably will need to be turned on in order to address the US debt crisis. And that's it. So for more context on this, 2 videos you should definitely check out, very in-depth. I go into both of these important cases. So first one is here. Here's when the money printing will trigger the crypto bull run, where I looked at the direct correlation between the last 3 times that the Fed has made this money printing to money the QE to QT pivot, and how that have correlated to exactly the last 3 crypto bull and bear market reversals. And the other video is talking about rate cuts and recession and why it doesn't matter for Bitcoin. So TLDR there is that everyone reads the rate cuts wrong. How aggressive Powell cuts rates do not contribute to asset prices. People way over speculate on this and they really don't understand it. You want a slow and steady rate cut instead of an aggressive rate cut, because every time that we had an aggressive rate cut, that meant something seriously is wrong, and that has always triggered a recession. So we don't want a fast cut. So watch these 2 videos for the full context on my channel. You can find them just right here. So in the live stream section, I have, where is it? This video talks about the money printer moving to explosive bull markets. And this video talks about rate cuts and recession and why that is misunderstood. Okay, so that's it. Takeaway here, don't worry. Do not use leverage. At any time, you got to expect Bitcoin to drop 10% and alts to drop 20 to 30%. And if you're not okay with that, you're not going to survive in this market. And especially during these FOMCs where people over speculate and don't on something that they don't understand, a lot of people get wrecked. But if you don't have leverage, you can just keep holding. And after watching these videos, like even if you understand this point, but your position is down like minus 60% because you have a 2x leverage, like what are you going to do? There's no other way to solve that other than to reduce your leverage. So very simple there. I think that's a good point, a good action point for everyone to protect themselves so you actually reap the benefits of this bull run. Even if we continue to get the delayed signal from the FOMC, at some point it will come. So you need to be able to survive until that happens. If you like this content, make sure to subscribe to the channel, share it with a friend, share this video in a humorous way with other people. Just really tell them to zoom out, take away all their leverage so they can survive this market. And if you like my style of analysis and if you want my quickest alpha, you should definitely follow me on Twitter or X at VirtualBacon0x for all my quickest alpha, state of the market, digestions of FOMC, etc. And if you want a trading community, check out the Coiners with the first link in the description for our private live stream signals, chats, and talking with other analysts as well. Okay, that's it. Thank you guys for joining, and I will see you on the next video and the next live stream.